All right. Good morning, everybody. Hope you all had a good weekend. Markets are getting a little bit of a rebound this morning. Over the weekend, Yellen, in an interview, said, "We have achieved the soft landing." Markets seem to like that. I wonder what other fairy tales they're going to come up with. Today, we've got the Apple event this afternoon. It is a recurring event, happens every year. We've also got wholesale inventories and consumer credit. And if you're looking at the numbers and kind of dig a little bit behind these numbers, the inventories have been increasing steadily over the last year. And the consumer credit is backing away from credit cards a little bit. So the rising inventories, it happens every year. It's seasonally. Black Friday sales event, Christmas holiday seasons. So there's always a buildup in inventories for that. But there is the worry also of a buildup in inventories, or what looks to be a buildup in inventories turns out to be something worse than that, right? Inventories that aren't getting moved because consumers aren't buying it. So we'll see. These get revised as well, right? You get the headline numbers, and then when nobody's looking, they go in and revise the numbers. So that's going to be at 10 with consumer credit at 3. We have auctions today at 11:30. Like I've said before, if you have auctions anywhere 11, 11:30, or 1, then just assume that those other 2 time frames also have auctions, even if they're not listed. A lot of things don't get listed on a day-to-day basis. Even checking multiple sites doesn't always get it taken care of. $54.63 is the ES halfback for Friday. So if you measure all of Friday from high to low, the midpoint would be 54.63. We're there. We've hit it twice now, really just not making our way through there yet. But we did just get a higher low. Excuse me, we just get a new high on the day. But right now, looking to see if we're going to continue to set these higher lows, or if we're actually going to finally break this move that we've had all night. It's worth keeping an eye on that level. It ties right into a dead cat bounce, right? We fell pretty good on Friday. If this is a dead cat bounce, then it's likely we won't make it through that halfback level. We will reject there and then continue the move to the downside. We could overshoot it. Remember, price does not see this line. It doesn't care that we have a line there. And this line isn't what makes price move. So we could get on the other side of it. Liquidity resides on the other side of the pivot. It wouldn't surprise me, if we even get up into like 54.70. It would still be a focus on this halfback. Overhead, we have the 3-week moving average, 54.81. We have the 10-week 54.97, zero gamma, volatility trigger, the 10-day and the 20-day, all of that over our head, and Friday's high, right? Just to top it off, as if we didn't have enough up there to worry about. So we could move to the upside, sure. I'm not saying we can't, but that's a lot of stuff that we have to work through. It's very likely we're going to start to see more rolling. So don't be surprised if we start to see market maker moves. That usually happens in the last week of the contract, and we're not there yet, but we're getting close, right? So we want to, just be mindful that if we start to see market maker move, label up here, that we might want to follow it up, actually go in and look at the trades that are being taken to see if it truly is hedging or not, especially if it's in the middle of the day and there's no event on the horizon, no reason to believe that they're hedging in the first place. We are already through the upper ADR. We got there pretty early last night. So we're through the top one. And we're about halfway to the full ADR. The ADR right now is pretty narrow because of the sideways nature of the market over the last week or so. So we have a 71 point ADR, or 72 really, if you want to round it. It didn't take much to get to that red line. Right now, a simple focus would be, if we get back underneath that red line, we'll target this other one for the end of the day. 53.74. Just like that. I know it doesn't always work out to be that easy, but Friday, the call out that I gave was, all we have to do is break this 786 level and we'll have a beautiful short. And that's exactly what we got, right? All we have to do is set up, get our key levels, and then run the thing. So that red line's a little farther down than I would like. Be nice if we had something a little closer to work with, but it'll work, right? We're talking from 54.46 to 53.76, just to use some easy numbers. Works for me, right? So let's get under that red line, activate the short. And of course, now that we've already pulled back from the highs, if we do get a short to play, we've got a half back level, 54.29. I would just adjust that and say it's 54.32 cog line. We've got a gap down here that needs to be filled. And yeah, we just run it from that, right? On the other hand, if it doesn't go down, get through the half back, we get into the full ADR. After that, we'll want to focus on levels from Friday. So we could take like just the Globex range itself, 54.92 cog line. And then of course the open on Friday, the RTH open, and then Friday's high. That would give us two more levels above, and 55.11 cog line, which is pretty close to the open. So round number 54.92, round number 55.11, RTH open, high of day. No matter which way this market goes today, we've got a nice setup to trade it. All right, one thing at a time. We've got this really large weekly floor pivot channel from 55.31 down here to 54.49, right? So it's really wide channel with the floor pivot in the middle, that weekly pivot. So 54.89, really close to the 54.91 cog line. It's going to be a significant level to get through if we can even get there. Then we have our daily pivot down here. We're already above the daily floor pivot, but we opened underneath it. And today's pivot is not inside yesterday's at all. They're not touching. It's also really wide, implying that we're going to hold the range here. A wide channel suggests that if we do break out, the breakout fails and we come back in. Now, these channels don't make price do anything, and they can't make us come back in and hold the range. We're just trying to get a perspective on what should the market do today when it comes to a breakdown, a breakout. Does the market even have the legs for that sort of move? We don't have the AM notes yet, so we don't know what the gamma level is. But it changed radically the other day. The Thursday night gamma levels were minus 3.8. The Friday morning AM founders note, the gamma levels were like negative 0.5, right? They were radically different numbers. So Friday's spot gamma in the evening was -2. That's pretty negative, but now I don't trust the PM one's spot gamma index numbers. I want to see the AM numbers because the discrepancy between those two is like the Grand Canyon. If it's -2, which is what it was on Friday at the close, that also implies that breakouts can move, right? So we got channels saying breakouts fail and we're going to come back in the line, and we got a spot gamma report that says breakouts can grow legs and really run. Generally, I want those two to agree with each other. They'll both say breakouts shouldn't work, or they'll both say breakouts should work. If they're not in agreement, then we just pretty much take both of them, chuck it in the trash. So it won't be useful. The point of control for last week, 55.22. So any move to the upside, we're going to have to fight through that level as well. After we get through the roundy and the 55.11 cog line, we've got that 55.22 point of control. And it makes sense, right? Because it was Tuesday and Wednesday and part of Thursday where we just stayed in that range, building up a lot of volume. But now that's a significant level of resistance overhead that we've got to work our way through. On the one hand, if we start getting close to it, we'll likely gravitate to it, but we got to get close to it for that gravity to kick in. Volume does look good this morning, but I'm going to attribute this volume a little bit to the contract change that's coming. There's a lot of places that don't want to wait to the last minute, right? They'll just go ahead and get it done early. Ten-day, 30-minute volume profile. We're not expecting any change here anytime soon, but it does highlight that 55.32 cog line and a significant level of resistance. So this is a 10-day profile, right? The 5-day profile that we were just looking at had a point of control at 55.22, which is really where this largest part of the profile is in this lower volume node. But this entire zone is going to be difficult, and it's 10 points wide from 22 to 32. So this whole region is just going to be a significant level of resistance. if we can even get into it. We are building out a lower profile down here at 54.22. But that's not going to be helpful until we know it's actually going to be supportive. And right now we don't know if it's going to be supportive or not. We got to come down and check it. $54.59 was a VPOC that we ran into on Friday, and it didn't really help out all that much. We cut through it and we paused there for a moment, and then we were done with it. We are going to have a new profile now. Well, we would have had a new one. It would start from Friday, but we ran into it, right? So we opened up and we ran right through that profile. So the textbooks will tell you to carry it forward, right? They'll say find the point of control from Friday and put it into today's trading along with the value area high and the value area low. It'd be all three of those lines. I'm not going to do that. I've already got enough lines to deal with. I've got enough levels. I don't need these. I only carry them forward if they haven't been hit yet, and that one's been hit. Now this one also above 55.24, that is another one that we hit on Friday. So we're going to take this one off as well. And now we don't have any close VPOC levels. If we continue the move to the downside, 53.67 is another VPOC level, but we'd have to get through 54.32 cog line, 54.11, 5400, 5392, right? You can see how all these levels, right? Just stacking them up, another one, another one, another one, plus Friday's low. So on Friday, we measured next week's range, but it was only a projection, right? We didn't know for sure if that was going to be the full range or not, because through the day on Friday, things could change. Well, that's last week's, and this is this week's. To be fair, last week only had 4 days, and this week has 5. So if we wanted to look at 2 weeks ago, this week still comes out ahead. So as you can see, the box that I drew is smaller than the range that we have this week. This range is built on volatility. So when volatility is high, the range is bigger. And when volatility is low, the range is smaller. There's a lot of volatility being priced into this week's market. That can be a little tricky because if it's an event, then it's generally something the market pauses and waits for, and it will suppress volatility, not increase it. Like FOMC, it's a volatility suppressor. Friday was the start of the blackout period for the Fed too, I believe. So we're on blackout before FOMC, which is one of the reasons we had Janet out chipping her teeth. She loves to go out talking when she doesn't have to share the media with any of the Fed members. And according to old Janet Yellen, we got our soft landing. We're still 1.25% below the 10-day. Being under the 10-day means we're under a resistance level. The 10 will resist price when we get to it. So we got to get to it, get through it, and start working our way above it. We are on the rebound after getting more than 2.5% under the 10-day. So we have pulled back from it quite a bit from that low that we had. But again, it kind of lines us up with like a dead cat bounce at this point. We don't have a sustainable rally yet. We're 0.75% under the 10-week moving average. The 10-week is another resistance level. It's going to be hard to get through that. But first we have to get to it. Last week we got close to -2% from the 10-week. We're now working our way back towards it. But the 10 is also coming towards us, right? So they're moving towards each other. Let's get there first and then deal with it. See if we can get the cross through or not. So it's worth backing up and taking a look at what we've got to work with. If we're just measuring this right here, then last week we fell down and we tagged that half back perfectly. It needs to hold. All right. That's one piece. It has to hold. If it doesn't hold, then we're very likely going to come back down and retest some of these lower levels. Any move to the upside, 55.31. It's last week's halfback, and it's also a cog line. So it's going to be a significant level of resistance. The worry is right now that we've come down and we've bounced, and we're going to run up and hit our head on resistance, and then come down and break that 5,400 and continue the move to the downside. This would be a complex topping pattern, and it'd be a very common pattern. If we can get through this halfback and continue the move up and set an equal high or even a new high, then it changes the narrative. It changes everything. But anything less than that, an equal high or a new high, means that we're just coming up, setting a lower high, and that we're very likely going to break that level and continue the move to the downside. But this low cannot be broke or else. And that is a long ways off, right? So if you go back in the past and you kind of look at it from this perspective, we set the low, we ran up, we set a lower high, and we came back down and we broke that low and got new lows. And then we had to work our way back through all of that. So a significant level overhead, 55.32, and one underneath this, just call it 5,400 or 53.92 if you want to stick with the cog lines. Price is trapped a little bit here, and it's still a conversation about, is this a dead cat bounce or not? Because if it is, then we're just bouncing into resistance before rolling over and continuing the move lower. And if you did keep the old level, then 54.20 would be this move here. That's the halfback. I like the new level, but either way, one, the other, both. So I mentioned the moving averages. We've got the 10s overhead, and we're fighting with the 20s right now. The 10-week and the 20-week have not crossed, so that's kind of a big deal. All right, things that are down this morning. China bonds, nat gas. The Fang down is down, but it was up, more than 20% in the last 5 days. So it's not a surprise that it's down a little bit now, like a mean reversion, right? It's just kind of pulling back a little bit. Bitcoin is up, multiple versions of it, right? So it's the proxies too are very likely up. Uranium, semiconductors, the Mag 7, tech, growth, more Mag 7. Little surprised to see financials are up too. Consumer discretionary, that's the three that we need, right? When we think about the sectors that we need, we have risk on sectors, risk off sectors. Well, the risk on is consumer discretionary, financials, and tech. We need those three, but I mean, really, we just need two of them at any given time, and we're good. We don't normally get all three. It just lines us up for a really good blowout move, except how negative we've been, right? This change over the last 5 days is showing us that these names have been beaten down pretty heavy. Semiconductors like SMH, this thing was down more than 12% over the last 5 days. So sure, it's up 1% this morning, like, like a dead cat bounce or a little bit of mean reversion. So approach with caution, because while this looks really good, when we go in and look at, all the resistance that we've got on the ES, all that overhead trouble that we've got to deal with, I don't see an easy path forward here this morning. The economic data is going to have to light up and get everybody excited. We got that bull steepening going on with the 10-2. It's just not looking good out there. We, haven't even got into things like CTAs, VC funds, the buyback programs. We haven't even talked about that. So, and the ES and the NASDAQ are like neck and neck this morning. If this was one of those face ripping blow off rally kind of days, the NASDAQ would be doing exponentially better than the ES would be doing this morning, right? And sure, they're not perfectly in line. We got 0.1% more in the NASDAQ than we do the ES, but that's nothing for the NASDAQ. We still have the dollar trying to rise back up. It's back above 101. That's a start, but we've got the 10-year still below 3.8. Crude's not looking too good at this point. It's stuck on its halfback, just like the other two indexes, but maybe gold has something a little better to offer. Not really. Range bound and sideways in gold, oil, S&P, NASDAQ. The 10-year, the only one that it's expanding this morning is the dollar. Pot stocks are leading the way. You don't want to rally on the back of pot stocks. And then Bitcoin. So we got Bitcoin proxies likely. Riot, Mara, Hut, Hive, Hood, MSTR. But most of these are trapped inside of yesterday's range and they just don't look good. and it's just been a significant beatdown. I mean, look at MSTR. Those sellers have been walking it down nice and clean. If we get a chance to short from 120 or 125, it'd be a nice play. Uranium's also up. So, a couple of uranium plays may look decent, but also stuck inside yesterday's range. That's going to be the narrative, right? On just about anything you look at today, it had a big move Friday. It's stuck inside of Friday's range. And that's going to be the hell that we got to get through before we can start to do anything else. Up or down, we've got to get out of that range. And there is the Monday gap, right? That conversation about how do you want a Monday to open in the indexes? You would think gapped up sounds good, right? And you're not wrong. If we're at the lows, a weekly gap up, like a evening star, or excuse me, a morning star reversal gap up, 3-bar play, and then a rip to the upside, that's a really good way to start the week. Otherwise, if we're not at the lows in a 3-bar sort of morning star setup, you kind of want a gap down. You want a gap down, and you want that kind of capitulation selling, and then the long wick reversal and rally back up out of the hole, right? And I've showed those before when we have those sort of weeks. So we're opening gapped up Monday morning. That's how we're going to be, sitting this morning, is with that gap up. But we're not at the lows of a run, right? That was back here. Not here in the middle of nowhere, in the middle of the range. Still, when we come into the open, we're going to be looking for that gap. And this chart really doesn't do it justice because it's counting the open from the Globex last night. It's not counting the open from 9:30 this morning versus where we closed on Friday at 4 or 5, depending on which broker you use. So there is going to be a weekly gap here, very likely, and it's in the wrong spot, which kind of implies more of a gap up fail rather than a gap and go. So we'll see. It'll be there on the SPX, right? We don't want a gap and go from this location. Yeah, crude, financials, technology, precious metals, gold, mining, everything is stuck inside that really big day. And that's what we've got to deal with. Keep your eye on that. If we can get through the half back, then we'll run it level by level, right? Take it back to the top of Friday and then out the other side in whatever you want to trade, uranium, Caterpillar, Apple, whatever, right? Whatever. It's all got to get through those levels. Be careful, be safe, watch the clock. I'll see y'all tomorrow.